But let's just start off with the first thing that you need to do in order to have a good rising income approach with stocks. The first is you need to choose a winning group of stocks. You need to choose a winning group of stocks that have a successful dividends track record.
Welcome to the Market Call Show, where we discuss investing wisely and living well. Tune in every week to Apple Podcasts, Spotify, Google Play, or subscribe on YouTube.
Okay, today we're going to be talking about a winning strategy for people who are looking for rising income. What spurred me to want to talk about this was that, frankly, there's a lot of people that are needing rising income. They need rising income because inflation continues to go up and many people are retiring and they need an income stream that's going to keep up with inflation. So I wanted to talk about a strategy that is very effective, really as a core strategy for people who are needing rising income. Because one of the most common challenges that investors face is that over the long term, especially when you're trying to fight inflation, your expenses continually rise, and you need a combination of long-term capital appreciation and growing income. So a dividend growth approach is one of the best strategies to achieve rising income. Now, I want to share today a method to accomplish this goal, and I'm going to be very specific because I find that people really feel more comfortable when they understand what's behind the curtain in generating a portfolio that you can really rely on, especially when you're dealing with your core strategies. So this method can give you some ideas to form a core strategy within a retirement income plan. And it's designed to be really a bedrock of the portfolio, but it's also a good idea to have satellite strategies to enhance the returns over time for the portfolio. But let's just start off with the first thing that you need to do in order to have a good rising income approach with stocks. The first is you need to choose a winning group of stocks. You need to choose a winning group of stocks that have a successful dividends track record. So you got to get that universe right, and that's crucial. So what I like to do is I like to start off with the S&P 1500. The S&P 1500 includes large companies, mid-cap companies, as well as small-cap companies, and they're all in the United States. And I like to filter out from that group companies that have excessively high yields, because companies that have really, really high yields, it's generally unsustainable. I want to make sure that the dividends that are there are well supported by earnings, as well as the company fundamentals, and that they have the ability to provide a competitive advantage. So the numbers are basically showing us that these companies have a strong business and a competitive advantage. So I want to explain a little bit more about like establishing the universe, if you will. The other thing I like to look at is I want to look at the daily dollar volume and eliminate those stocks that are really illiquid. So the daily dollar volume just says, okay, what is the average volume of the stock in the market, and multiply that times its price, and that gives you kind of the dollar value that is traded in a given day. So typically, I rank order those companies, and I want to make sure that they have that they're usually in the top 90%. So like the bottom 10% of illiquid stocks, I generally want to ignore them. And then I also have a cutoff, a dollar cutoff, to say it needs to be at least X. And that number does change depending on the purpose. So basically, get rid of those stocks that are too illiquid. You don't want to have them in your strategy because you're really looking for those solid companies. So I also want companies that have a long-term track record. So I exclude stocks that have a track record that is less than 10 years. Now, some people say, well, wow, there's a lot of great companies that you're missing out on. Well, that is true, but I like to look at those younger companies for different types of strategies. For this strategy, this is a strategy that's designed for steady, growing income stream and long-term capital appreciation. So we're not really trying to hit the cover off the ball. We're trying to get steady growth of rising income and also getting rising capital appreciation. So we want to get rid of those companies that have a 10-year, less than a 10-year record. And now is for the best part of the universe selection. I want to exclude stocks that are not raising their dividends. So I'm looking for companies that are raising their dividends every year and they haven't cut their dividend in the most recent 4 quarters. So in the last year, they haven't cut their dividend. They may have kept them the same, not necessarily raise them, but we're looking for annually successively higher dividends, and then we're looking at the quarters and saying you're not cutting the dividend. This really narrows the universe down. And like for example, as of right now, that universe is 341 companies that I just outlined. So you want to start off with those winning stocks. So now we've got this group, this universe of companies that you've really shut off a lot of dead weight. You're only including those companies that have a long-term track record of rising income, and they have the characteristics that can get you headed in the right direction. But you don't want to leave right there. You also want to actually move from there and actually look at these companies fundamentally. So you want to demand from these companies that they have steady rising dividends and strong earnings. So a critical aspect of this strategy is to focus on companies that have adequate analyst coverage. So analyst coverage would be is good to have. You want to make sure that you don't want to make it too stringent because there are some smaller companies that you want to have investment in and they may have less analysts following them. So I have found in today's marketplace that the sweet spot's right around 5 analysts. So if 5 analysts are covering it, you still have a big universe of companies that are in the smaller market caps, as well as the mid cap and the large cap. So why do you care about whether or not Wall Street is looking at these companies? Well, the first thing is there's a lot of value in actually assessing and analyzing the change in what's happening with analyst expectations, because stock returns have high correlation to these changes. So we're looking at earnings surprise. We're looking at whether the company is beating expectations, or whether analysts are starting to upgrade a stock because that's really indicative, showing that the company is actually improving their results. So part of the equation is looking at expectations, and another part is actually looking at what is actually printing and what the company is demonstrating with their fundamentals. So that's why we want to have at least 5 analysts covering that. Another thing that we want to do is we want to, like I had mentioned, we want to have rising dividends. So as we narrow that universe down, we're getting to a high quality basket of stocks that can build a reliable income source. Now, the next step is I like to kind of think of building a portfolio like cooking. It's like having a good recipe. So what I'm outlining for you right now is a recipe. So you want to build a tasty recipe to get better results. And that means you got to build and manage the portfolio and select from this list of companies. You can just buy all of them if you wanted to, but if you want to get better results, I recommend, or I like to limit the sectors and the industry weights of companies, and I like to first look at them fundamentally. So we're, looking at these companies from many different directions. The first would be quality. How profitable are they? What is the return on capital? We like companies that are capital efficient. Are they growing their sales and their earnings? And to what extent are they really printing good numbers there? The other thing I like to look at is, there's just so many different things, but I mentioned the sentiment aspect about what the analysts are viewing, how they're viewing the company, but also we want to actually look at just the profitability, the quality, the valuation. So once that's been analyzed, there's a qualitative thing that I like to look at, and I call it ADP, and it's A as in apple, D as in dog, and P as in profits. I outline that in my book, actually, The Financial Freedom Blueprint. And, I'm really thinking about writing another book because I have a lot more that I want to share with people. But if you go to my book and you go to page 22, I outline the ADP criteria. And this is how focusing your capital on companies that have a few different characteristics. Number one, are they adaptable to changes in technology and innovation? And number two, do they have desirable products and services that are desirable now and likely to be desirable in the future? So it's not a fickle thing, because for this portfolio, we're really looking for long-term growth, right? And compounding growth. And are they profitable? Is their business model such that they're getting good returns on capital now and is likely to do so in the future? So it's really an assessment of now, actually demonstrating it, as well as, when you're looking at the company's business model, is it likely to sustain in the future? So those three things can really, really help you to have better returns than sticking your money under the mattress. And also better returns are more likely than you would get in bonds by a significant margin. Okay, so once we've done that, we've done the fundamental aspects and looked at all the quantitative methods. Basically, I like to quantify those into ranks, and that really keeps you disciplined so that you can compare companies to each other. So the next step in this is something that's really important, because what a lot of people don't understand is that stock selection or investment selection is very important. But what is equally important, and could be sometimes more important, is how you blend and how you put the portfolio together. That's called portfolio construction. So there's some key elements, and I'm just going to give you some of the broad strokes here. Limiting your sector and your industry weights is important, because you don't want to have too much concentration, and you want to make sure that you're not, 70% in tech stocks, or 50% in energy stocks, anything like that. You want to have some balance there, because that generally will improve your risk-adjusted return. Because when you're retired, or when you're generating income from pulling from your portfolio consistently, you need to have some more stability in the portfolio. So you also want to have individual position sizes, so the amount of capital allocated to each individual stock should also be limited. So typically the range between 1 and 5% of initial capital is a good place to go. In terms of getting adequate diversification for a portfolio like this, looking at a lot of different ways you could go, really a 50 stock portfolio is a good starting point for a high net worth investor. You want to own those stocks individually rather than going out and buying some packaged product. This gives you a lot more ability to home in on exactly what you need. So once you've invested in these stocks, it's not just set it and forget it. It's an ongoing process. So you want to allow some drift with these stocks. And typically I like to let stock portfolios or individual stock positions drift about 30% from the target. So if we have a target weight of 5%, then it could go up, 0.3 times 0.05, so 30% of your target position could go up or down. So you want to give some drift, because you don't want to have, you want to give these companies some room, and you don't want to rebalance too frequently, because this needs to minimize your turnover. So we want to place those constraints on sectors and industries to ensure good diversification, and their businesses should have non-correlated factors of returns that generate revenue and expenses for the company. They should be relatively non-correlated. Okay, so let's talk about like how much capital that you put in stocks over time. So my approach is to dynamically adjust target weights based on fundamental rankings, basically. And the fundamental ranking is all those factors that I mentioned to you: the quality, the valuation, and there's multiple dimensions, in how you look at those companies. But how are they? Are they improving? Are they not improving relative to the whole basket? And typically, if you look at the whole universe, we're typically focusing capital in the top quartile of companies in there, in the universe. And if the companies fall out, maybe falling into the bottom quartile, typically they're going to be removed from the portfolio. Let's talk a little bit about selling and how important that is. So this strategy, generally it's a moderate turnover strategy, so it's not a high turnover strategy. Because you're really looking to hold on to those great stocks as long as possible and earn the compounding dividends. But you also want to make sure these companies are doing well fundamentally. So one reason that a company can get pulled out of the portfolio would be if they cut their dividends, because they're no longer in the universe at that time. So if their dividends are getting cut, they're going to be eliminated from this strategy. If they are no longer as liquid as they need to be, they'll be eliminated. That rarely happens. The other thing is if their fundamentals deteriorate enough, then we're going to need to pull that stock out of the portfolio because they no longer meet the criteria of strong fundamentals, which is a high correlation to expected returns in the company. So those are the main reasons why you pull stocks out. And you want to just do this continually. So there's really basically two processes. There's what's called reconstitution, which is basically when we say, okay, what does the universe look like? And then what are the rankings right now and who's in and who's out, right? And then there's rebalancing. And that's the process of saying, okay, here's our target weights based on the fundamentals now and the market cap, et cetera. And based on that, how far are we off from that? If it's within range, no problem. If it's out of range, then we need to pull that back. So let's talk a little bit about that. So we're talking about recognizing when you need to cash out, right? So just to recap, selling criteria is really straightforward. Stocks are removed if they cut their dividend, if they drop in their fundamental ranks, right? Typically below the 25th percentile. And again, this approach helps you maintain a portfolio of top performing liquid stocks with a strong track record of dividend growth. It's a really simple concept that is very effective. So by adhering to these rules, the portfolio remains robust and avoids overconcentration in one sector or industry, right? Because we have those constraints, and is providing steady, reliable income and returns over time relative to more speculative investment strategies. So I want to talk a little bit about the mindset of this strategy, of having this as a core part of a portfolio for somebody looking for rising income. You really should have a mentality of hold and prosper. I like to think of it that way. You want to hold and prosper because you really reap the rewards over time with these stocks. As they're building their profits, they're growing, the dividends moving up, and it just keeps going up. And we're focusing our capital and our attention in those companies. So it's designed for long-term investors who are seeking that steady growth in income. It's not meant for market timing. It's meant for that reliable income. And the volatility of this strategy has been lower than the overall market. So one of the things we like to look at is standard deviation. You probably have heard of that before. But if you look at a simulated result of this approach, its standard deviation is 13.19% since February of 2004. And the beta is 0.72 compared to the S&P 500. So it makes it suitable for a retirement portfolio where stability is important, right? And historically, this strategy has performed well too. It's annualized at 12.2%. But whenever you're looking at simulated strategies, it's important to understand, as with any investment strategy, past performance doesn't always be an indication of future results, right? It's important to understand that. And returns, that I'm talking about here have a provision for transaction costs, but it doesn't include advisory fees, okay? So that's just, something to understand. So the performance has shown to be very competitive, and it's generating what we're looking for, a rising stream of income. So you want to choose the best stocks and let go of the rest. That's really the key on this. So historically, this portfolio shows moderate turnover. It's been around 0.57% annually, 57%, I should say, annually. And the average holding period is over years typically. Winners are held on average 646 days. So that's well over a year, while losers are held for roughly on average 300 days. So you want to have, we're not trying to generate a lot of short-term gains here, right? We're trying to build long-term capital appreciation. But one of the key aspects is you'll notice is that the days held for losers is a lot lower than the days held for winners. And sometimes you can hold winners for years and years and years. Like, for example, Costco or Microsoft. Apple, Nvidia is in there now. So you want to understand that there's going to be some outlier stocks that you hold for a very long period of time, but these are just average statistics to understand. But this disciplined long-term approach helps you balance this risk and return target that you're looking for, and gives you that steadier return. So just overall, this is I consider it a bedrock strategy for people who are retired. It adds for stability, And one of the things you can do with this is you can blend in other portfolios around it as satellite positions. For example, you could have high quality municipal bonds to save on taxes, and that could give you a different return stream, more conservative. Same with corporate bonds, if that makes sense for you and your tax bracket or the type of account that you have. Private real estate can be very good in this, and that is something to really consider depending on which areas look the most attractive there. But that can enhance your income and mitigate risk during market downturns. Because again, this is a stock portfolio, so it's going to fluctuate. And it generally has historically fluctuated less than the overall market. Most people are in the S&P 500 type companies, and those stocks have fluctuated more, which makes sense because these are lower duration stocks that are paying you dividends now. And then owning around 50 stocks offers diversification across those industries, and it can help you counter that inflation and the tax problem that people have over time, over retirees' lifetime, which could be 20, 30 years. So that's pretty much it that I had for you today. I hope you've gotten some ideas, insights, maybe on how to incorporate a dividend investing strategy for yourself, even for people who aren't retired. A portion of your portfolio in this type of strategy is a great complement to more aggressive, fast-growing type company strategies. There's another strategy that I manage called the fundamental trend strategy that is more geared towards fast-growing companies. They could be younger companies, more dynamic companies like that. It's a great complement to that type of strategy. When you put those two strategies together, you get a really nice blend. So thank you for listening, and hopefully you get some ideas about dividend strategies. And if you found this helpful, share it with your colleagues, any friends or family, and follow me for more, and like and subscribe. Hope you're doing well, and we'll talk to you next time. Bye.
For the latest episode of the Market Call Show, make sure to like, subscribe, and follow us on X, formerly known as Twitter, and YouTube. Go to www.marketcallshow.com for all our past episodes and sign up to get alerts. If you enjoy the content of this episode, please share it and comment. The information in this podcast is general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriately qualified professional prior to making a final decision.